The recession is underway. People are getting kicked out of their houses. The American housing crisis is an unfortunate reality sweeping the nation, exacerbated by the current economic recession. The fear of being forced out of one's home is becoming all too real for many families. Watch this video to the end as we delve into the stark realities of this devastating crisis, shedding light on the profound challenges faced by those fighting to keep a roof over their heads. Diving deep into the intricate web of factors fueling this housing crisis, we highlight common misconceptions and provide a clear-eyed analysis of the current situation. Please support our channel with a thumbs up and don't forget to subscribe to our channel. At present, the financial obligations of the U.S. government have spiraled out of control and reached an unprecedented $33 trillion. This staggering amount surpasses the nation's gross domestic product by more than 100%. For a long time, the government could borrow at exceedingly low interest rates due to the policy of interest rate suppression. However, the situation has evolved, and now it demands particular attention from investors, home buyers, and anyone who follows the economy. The government's interest burden on the existing debt has surged because they now have to repay the previously borrowed amount at higher interest rates. Before this increase, a majority of the debt incurred low interest rates. However, it must now be repaid by the government at significantly higher rates. The Federal Reserve's actions are also restricted due to several factors affecting the economy. Although inflation has been on a downward trajectory, recent increases in food and gas prices have caused a resurgence in inflation expectations among consumers. This is corroborated by the Consumer Expectation Survey conducted by the Conference Board, which reveals that consumers now anticipate a yearly 5.8% rise in inflation. While rent prices have been receding in some locations, this decline is offset by the upsurge in food and gas prices, contributing to an overall inflationary environment. Given these developments, the Federal Reserve is limited in its capacity to adjust interest rates. In the face of surging inflation expectations, the Federal Reserve is constrained by the current dynamics of the economy and may be unable to enact meaningful cuts to interest rates. To address these concerns, policymakers need to employ alternative strategies to manage inflation and ensure economic stability. The stock market state also warrants an in-depth analysis. The stock market appears to be reacting negatively to recent economic developments, as investors now believe that the Federal Reserve will be forced to adjust its monetary policies. Specifically, there is speculation that the Fed may halt its interest rate hikes and implement rate cuts in light of these economic conditions. The singular reason may account for the sharp and unexpected rebound of the S&P 500 index, which had plummeted only a couple weeks ago. We must note that some investors are not basing their decisions on the underlying economic fundamentals, but rather on the optimistic projection of a potential Fed intervention. Analysts predict that it is conceivable for the Federal Reserve to make this transition only after significant job losses, evictions, and other forms of economic distress occur. In turn, it is anticipated that the United States government may execute a bailout plan. There is an increasing likelihood of another bailout due to the growing severity of the current economic downturn. While the government and Federal Reserve possess the capability to execute a bailout, investing in stocks or housing on the assumption that the Fed will undertake a pivot and the government will inflate the money supply is not a sound investment thesis. This is because such assumptions lack support from empirical evidence and carry significant risk and uncertainty. Investors should be cautious and seek reliable, factual information before making investment decisions amid the current economic climate. According to statistical data provided by Redfin, about 30% of homes purchased in this specific zip code 90009 LA were acquired by real estate investors in the previous year. However, despite some noticeable improvements in the area, it is worth noting that a significant number of homes in this locality still have metal bars on their windows. Surprisingly, despite these limitations, the Zillow property listing portal shows that most of these properties are listed at a price range of almost $800,000, with an accompanying monthly mortgage payment of around $5,500. This is a remarkable instance of how property values are influenced by various factors, some of which may appear counterintuitive to most real estate buyers and investors. Purchasing a property through a mortgage in the current market has become increasingly impractical. What many large corporate investors tend to do, instead, is to use certain neighborhoods as a form of pump and dump operation. Essentially, they acquire lower-cost properties in these areas to benefit from appreciation during a market upswing, but exit just before a crash occurs. This practice is ethically questionable as investors prioritize their own financial goals at the expense of the local community. It creates a volatile housing market, curtailing the prospects of sustainable home ownership for ordinary families. Such an action can lead to an increased demand for rental properties, which exacerbates the housing crisis. As such, policymakers should address this issue of growing instability in the housing market by enforcing regulations to prevent speculative property investing. Certain cities and neighborhoods are experiencing a notable downturn as economic conditions shift. One such example is the South Central LA region that saw a staggering 50% drop in home prices during the last downturn. However, it is worth noting that in the years following the decline, home prices in the area have rebounded significantly. This is partly due to gentrification and significant investment activity that has driven prices upward. While certain risks are associated with this activity, many investors see sustainable potential in the South Central LA market. Throughout the economic downturns, cities such as Los Angeles and Miami often experience a sharp rise in unemployment rates. In Miami, the unemployment rate typically peaks at approximately 10% during such periods. Currently, however, the rate remains at a low 2.4%. Nevertheless, this favorable condition is unlikely to be sustained. Therefore, if one resides in a city with a known history of elevated unemployment rates during recessions, it is essential to consider the increased likelihood of significant home price declines. As the percentage of the government budget allocated to servicing interest payments continues to increase, the available funding for distribution to citizens decreases accordingly. Unfortunately, this situation paints a bleak picture for public spending. Nevertheless, it is conceivable that the government may adopt unexpected and unconventional measures. It has become increasingly difficult for individuals to meet the rising cost of rent, leading to a surge in eviction cases. The latest data on the evictions in America, provided by the Eviction Lab, indicates a marked increase in major cities such as Las Vegas, Phoenix, Miami, Dallas, and Houston. In fact, eviction rates in all these cities have surpassed pre-pandemic levels. This escalation in evictions raises concerns about the relationship between income levels and rent prices. The fundamental question is whether the current rental prices are realistic or affordable for people with varying income levels. Unfortunately, data confirms that a mismatch exists between the cost of living and average income levels, highlighting the precariousness of the situation. Addressing this issue before it exacerbates further and impacts housing stability nationwide is crucial. Investors seeking to purchase real estate near Los Angeles are encouraging cap rates ranging from 2 to 4%, indicative of an annual return in the same range. This scenario prevails in light of the 10-year Treasury yield standing at 5%. To offer prospective buyers valuable advice, it is recommended to focus on identifying locations with stability and a low risk of market fluctuation. Thorough research, analysis of market trends, and expert guidance will be instrumental in pinpointing areas with favorable investment conditions. In the end, investors would gain advantages from shrewdly analyzing the market and exercising prudence in adhering to sound investment strategies in order to maximize returns. Keeping a keen eye on the overvaluation percentage pertaining to your zip code is crucial. This parameter indicates how much home prices are marked above their fair market value. A higher overvaluation percentage implies that the chances of price drops are more significant. It is imperative to note that studying the local housing market's historical trends is paramount to all potential buyers. Being familiar with past patterns and developments can provide invaluable insights into the market's current and anticipated trajectory. Therefore, conducting thorough research and gathering as much factual information as possible is highly recommended before making any investment decisions. This is especially true for novice investors looking to foray into real estate space. For those seeking to purchase a property in an expensive market, there are several alternative ways of financing the purchase. These include tapping into 401k funds, utilizing home equity lines of credit, or negotiating with sellers on creative payment terms. Exploring government grants or other incentives available to first-time homebuyers is also worthwhile. Check out one of our recent videos on 10 tips for first-time homebuyers for more on that note. In a rapidly changing market, it is wise to stay abreast with the current trends and news related to local real estate. Furthermore, conducting due diligence before investing in any property is essential for successful long-term returns. These steps will help investors make informed decisions and ultimately position them for success. The housing market is continually evolving, and one should be prepared to adapt accordingly. By remaining informed, adopting the right strategies, and making the necessary investments, investors should be able to capitalize on the ever-changing real estate landscape. With these practices in mind, real estate investing can prove to be a rewarding endeavor. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.